and I hope are you still getting me? Are you still online, sir? Okay, we want now to just touch the introductory tenets about audit and assurance. We sent you materials about a week or two ago, hoping that maybe you were going to make something out of those materials, but surprisingly, you didn't do anything, Mr. Reason. What was the problem? All right, fine, sir, but in the field of accounting, you just have to cope up with the pressure. Unless we are people who are ready to handle pressure. Okay, so I want to share something with you, and I hope we'll go along together. So I just want to share some material here. I hope my computer is not going to misbehave, because it is starting to freeze now. So I just want to share something. I think that will be. Are you seeing something? Oh man, not the slide. You can't see the slide? Even now? Oh man. Yeah. Okay, let me just do the settings again. Submitted. Yeah, this computer of mine. You're not seeing anything again? Oh man. Which permissions are required now? Man, don't do that. Okay. Yeah. What about now? Hey, reason, hey. Yeah. But this side is saying that it is showing something. So what's going on? You're not seeing me? You're not seeing the slide on the screen? You can see something, right? Yes. Hi. Okay. I'm very sorry about this internet thing, but I hope the network is going to do a fence, and then we call it a day. Like I was saying, the work is going to be very, very enormous for you. Okay, it's going to be very daunting task, and for you to pass an ACCA exam, I'm sure you have realized in your initial modules, if you have written any ACCA module, have you ever written one? Have you? Yeah, that's good. It means that you are now aware of the pressure that is involved in these ACCA exams, right? Now, so when we talk of pressure, you mustn't be somebody who is a stranger to this type of pressure. Just have to manage the pressure so that we move, okay? Because by the end of the day, if you do not participate, you're not going to make it easier out of the exam room. You are going to at least going around and round and round, writing the same module. So I don't want that situation. I just expect everybody to just move on with his own life. After just 3 months, just have to start a new module. You can't hear anything? I'm good this way. Okay, but go is the good things way. Oh my God. Okay, let me just try to turn off this thing and use the laptop speaker. Maybe you're gonna hear me. Oh, quite okay. Hello? Hello?
Hello,
Are you still hearing me now?
yeah, now
Yeah. Okay. All right. Let us just go straight to the business of the day. This is just the same material which I gave you last time, and I just want to rush through the material. We must actually spend a lot of time reading. It's not about the reading, but it's about just explaining one or two theories which I included in the concept of auditing. Okay?
yeah, that's true.
All right. The AA paper is meant to give students the background and understanding of auditing theory. You will discover that when you do the AA paper, you are actually being introduced to the concept of auditing, but at the same time being drawn closer to the field. It's like it's not the same as just doing a Bachelor of Accounting auditing paper, but here you are doing it at a professional level. So the examiners expect you to show them that you are a bit mature and ready to do the accounting work as an auditor. Okay?
Yes.
So, students will develop knowledge and understanding of the process of carrying out the assurance engagement in its application in the context of the professional regulatory framework. So in this case, you are going to show the examiners that you understand what the professional regulatory framework espouses or requires you to do. So in this slide, the A paper structure is introduced. 3 introductory concepts will also be covered, namely assurance, corporate governance, and the auditor's appointment rights, removal and resignation, and regulation. So let us go straight to the syllabus structure. We have got 2 sections which we are going to be tested upon. There is section A, which comprises of 3 10-mark case-based questions. Each case is 5 objective test questions. So you are going to have a case study. In section A, there are 3 case studies which are worth 10 marks, but they will be having 5 questions per each case study. There are going to be 3 case study questions in section A, which have got a total of 10 marks each. So in total, there are going to be 30 marks for section A. Let me just use a marker here. We are saying in section A, sorry, what's happening? There are going to be 30 marks. And then section B, 70 marks. Now, section A, like I've said, there are going to be 3 case studies. In these 3, each has 5 questions. 5 questions, which are worth 2 marks. Okay? 5 questions, which are worth 2 marks. Okay, so in total, there are going to be 15 questions, which are worth 2 marks. You just have to show the examiners that you are ready to pass. Remember, every section is compulsory. So by being compulsory, what it means is if you show more effort on section B and neglecting section A because section A is a bit naughty and rude, then you're going to fail. Let's say you get 5% or 5 over 30 marks in section A and you get 65 over 70 in section B, you are going to come out with a 48%. Why? Because this is a compulsory. All sections are compulsory. So which means that you just have to show more effort in both sections. You're not going to say, I do not worry about section A, I just want to get my 70 marks and go home. You are going to fail. Are we together?
Yes, sir.
Okay, so in section B, there are going to be 3 questions. One of the questions is the 30 marker. Then the 2 of those questions is the 20 mark questions. So which means that these 2 questions will be having 40 marks in total, and the first question will be having 30 marks. So all in all, they become 70 marks. So what does it mean to pass paper audit and assurance? This means that a student can now or is now in a position to explain the concept of audit and assurance and the functions of audit, corporate governance, including ethics and professional conduct. The student can now demonstrate how the auditor obtains and assesses audit engagement, obtain an understanding of the entity and its environment, assess the risk of material misstatement, whether arising from fraud or other irregularities, and plans an audit of financial statements. So you can now be demonstrating that you can be hired as an audit senior. Okay, somebody who knows what he can do. Somebody who knows what is required. Okay, So much of that you are going to read on your own. Now, what is assurance? An assurance engagement is an engagement in which a practitioner expresses a conclusion designed to enhance the degree of confidence of the intended users other than the responsible party about the outcome of the evaluation or measurement of a subject matter against criteria. So when we are talking of an assurance engagement, we are saying that this is a particular engagement where we have got one person who is called the practitioner. There's going to be a practitioner. This is the reason why you need to undergo a series of examinations, practical experience requirements. You have to satisfy all those. You have to do supervised work so that you become an expert in the field. This is why you are being traumatized, harassed by these ACCA exams, because they want to make sure that you are now a practitioner. Are we together, sir?
Yes, sir. Yes.
Okay, so there is this guy called the practitioner, okay, who expresses a conclusion. He expresses a conclusion to enhance the degree of confidence of the intended user. So let's say there are financial statements which have been prepared by Mr. Reason. Okay, he has prepared these financial statements for the board of directors. But how can the board trust what Mr. Reason has written or has prepared? For example, shareholders, how are they going to trust that Mr. Reason has done the actual thing, has reported the actual things which are obtaining on the ground? We are only going to trust that after some practitioner assess that those financial statements have been well prepared. Otherwise, we are not going to accept anything. So this is why we have auditors who act as practitioners in the field of accounting. They will be assessing what the accountants have done to ensure that the users of the financial statements are not going to be manipulated, are not going to be tricked into something that does not exist. Okay, so that's the degree of confidence we are talking about. And when you are talking of intended users, these are shareholders, the government, the ZIMRA, etc. Okay, and other responsible parties, outcome of the evaluation. So this guy gives the outcome of his evaluation in the form of some report, etc. So we are going to cover all those issues to do with how this practitioner gathers evidence, how does he report that evidence, and so forth. Then, giving of assurance. When we are saying we are giving an assurance, this means that you are offering an opinion about specific information so the users of that information are able to make confident decisions knowing that the risk of the information being incorrect has been reduced. However, here we say that so that the risk of information being incorrect is reduced simply means that you cannot actually say because it was an audit, therefore everything that has been reported is actually correct. No, we are not going to give 100% correct assurance, but we are simply saying the risk has been reduced. In the form of an audit, this risk is actually reduced to material level. Okay, so audit is one form of assurance, and is defined as the independent examination of the expression of an opinion on the financial statements of an entity by a duly appointed auditor in pursuit of that appointment. The important words here are independent and opinion. Independence is essential and analyze the value of auditing. When you are talking of opinion, we really mean that one auditor could look at a set of financial statements and disagree with the opinion of another. Why? Because it is simply an opinion. Okay? However, there are international standards on auditing, the ACCA, which govern how the auditor should perform his audit, so that every other auditor who's going to review is not likely or highly likely to come with a more deviant opinion. Okay, we expect that even though the opinions might be different, but the disparity must not be so wide. Otherwise, the field of auditing would be susceptible to scams. scammers, those scammers. Okay, but because we've got international standards of auditing, the risk that the auditing work is going to be so varied is actually minimal. Okay, the elements of an assurance engagement. We've got 5 parties to an assurance engagement. Okay, do you have any questions so far?
Yeah, so far it's still clear.
Okay, I can hear that you have got questions, but you are scared of answering those questions. Don't worry, you are going to answer. You are going to ask. Let me just cover ground a bit. Okay, there are 5 elements or parties to an assurance engagement. Okay, there are 5 elements and 3 parties. Okay, the first elements include the 3 parties involved. And which are these 3 parties? We've got the practitioner. This guy is the reviewer of the subject matter who provides the assurance report, etc. He actually provides the assurance which is required on the subject matter. So this guy, in the case of an audit, is called the auditor. Okay, the practitioner is the auditor. All right. Then the intended users, these are the shareholders. The shareholders, they are the ones for whom the financial statements are prepared. Then we have got the responsible party. The responsible party is Mr. Reason, who has prepared his, the financial statement. Maybe he's a finance director or he's a finance manager. The guy who has prepared those guys, or who is responsible for the preparation. But usually, these are the directors, the board of directors. Directors as a board. However, this board delegates the function of preparation of financial statements to a guy called the FD, the finance director, finance manager, etc. Okay? Now, we've got also another party to the assurance engagement who is called the subject matter, the appropriate subject matter. The subject matter is actually that thing or that information that has to be assessed or analyzed. Okay, the information that is to be audited. That's the subject matter. But it is to be appropriate. The issue of appropriateness, we are saying that we can't audit something that is not subject to some regulatory framework. Okay? the subject matter in the form of in the case of auditing should be the financial statements which have been prepared. Okay, which have been prepared in terms of International Accounting Standards or IFRS or national legislation. National legislation, for example, the Companies and Other Business Entities Act. Okay, the Companies Act of Zimbabwe, etc. That's the appropriate subject matter. If you are auditing the financial statements of a company, you need to ask on what basis were they prepared. Otherwise, if they were just prepared using principles of the Masowe Shrine or some other rules or guidance, then it might become difficult for the auditor, because the auditor is going to just evaluate if what is being reported is actually in accordance with some applicable criteria. Are we together? Hello?
Yes, it's only that I lost the connection because someone was calling me. But 20 to 30 seconds, I just came up with talking about the Masowe thing, but I didn't know.
I'm not saying the Masowe is something bad, okay? I'm not saying, but I'm trying to say if the criteria is not actually I mean, if the subject matter is not something that has been prepared following some applicable criteria, it becomes difficult for the auditors to do their work. Okay? So in this case,
okay, now I understand.
You understand, right? So we are saying that the appropriate subject matter in this case is the financial statements. All right, those are the subject matters that have to be reviewed. Then there should be some suitable criteria against which the subject matter is evaluated. So this is why I talked about the IA, the International Accounting Standards, or the IFRS. Okay, here we are just saying that these are the laws governing the preparation. That's the criteria on which the financial statements were prepared. They were prepared on this criteria, following International Accounting Standards or following the Companies Act and so forth. Okay? Then, sufficient appropriate audit evidence. Here, we are simply saying that the auditor should actually strive to obtain sufficient appropriate audit evidence whenever he wants or whenever he's doing his duties. Otherwise, he mustn't just go there and get whatever he thinks is evidence to present before the shareholders. No, he has to come up with sufficient appropriate evidence, appropriate audit evidence. Sufficient, we are talking of the quantity. When we talk of sufficient, we are referring to the quantity of the audit evidence. It should be just more. We need more evidence, okay? But not any evidence, not any. So here we are talking of quality. Appropriate, we are talking of quality. Are we together?
Yes, sir.
So sufficient has to do with the quantity. Appropriate, we are referring to the quality of that evidence.
The quality.
Okay, now, lastly, a written assurance report in an appropriate form. Appropriate form suggests that for auditing, there should be some ISA in respect of that report, and the ISAs have got some model reports which auditors should follow. You discover, you know this as we proceed with the lecture. At the end of of our course, that's when we'll be talking about audit reporting. Okay, but basically this is the whole syllabus. We have actually talked about the whole syllabus of the auditing paper. All right, we talked about those appropriate subject matter. Okay. Right, here in detail, the subject matter can take many forms, such as financial performance. You may be asked to evaluate our financial performance, non-financial performance, for example, the key indicators to see if they are sufficient, they are fine, the key indicators of our operations, the physical characteristics, for example, the capacity of a facility. Okay, auditors may be called upon to come and assess. Then systems and processes, for example, an entity's internal control or IT systems, behavior, for example, corporate governance, compliance with regulations, etc. Okay, then the appropriate subject matter, we talked about that. Okay, identifiable and capable of consistent evaluation or measurement against the identified criteria, such that the information about it can be subjected to procedures for gathering sufficient appropriate evidence. We talked about that, the criteria. Also talked about this. The criteria are the benchmarks used to evaluate or measure the subject matter, and the major criteria in the case of auditing, that's the International Accounting Standards or IFRS or the Companies Act. This is whenever auditors have come, they would want to make sure that what you have reported or the way you have presented your financial statement, were you complying with the International Accounting Standards? So the criteria which they would be using to benchmark whatever thing would be the International Accounting Standards. Okay. All right. Here suitable criteria exhibits the following characteristics. If you have done your F7, have you written your paper F7? Your financial reporting paper? Hello? Okay. Hello? Okay. I'm sure this guy has disturbed, facing some little challenges, but purpose just presentation. I will continue. Okay. So suitable criteria exhibits the following characteristics, and these ones are usually guided by the conceptual framework. Okay, where we know that the financial information should be relevant, should be complete, should be reliable and neutral. Also, some understandability issues have to be considered. So, relevant criteria contribute to conclusions that assist decision making by the intended users of that financial information. Then, criteria is sufficiently complete when they include all relevant factors that could affect the conclusion. Then, reliable criteria allow reasonably consistent evaluation of the subject matter. Okay. Then, neutrality. Here, a neutral criteria so that conclusions are free from bias. Then, conclusions that are clear, comprehensive, and not subject to significantly different interpretation. So auditors should ensure that the financial statements are understandable. Alright? The financial statements are understandable. The evaluation on or measurement of the subject matter on the basis of the practitioner's own expectations, judgments, and individual experience would not constitute suitable criteria. So we normally not want to have a situation where a particular auditor's views dominate more than what the suitable criteria should be. Okay, some auditors might dominate the process of financial reporting outside, which their domineering would be outside the remit of the conceptual framework of the International Accounting Standard on auditing, or even the International Accounting Standards, or IFRI. Okay, in that situation, this is where we are saying that we do not expect that to prevail. So the criteria need to be available to the intended users to allow them to understand how the subject matter has been evaluated or measured. So this means that the users are actually aware, or should be made aware, on what basis the financial statements prepared. So they should be told that we have prepared the financial statements in terms of International Accounting Standards or International Financial Reporting Standards, or in accordance with the Companies and Other Business Entities Act of Zimbabwe. Now, when you talk of sufficient appropriate evidence, we say that we are referring to two things here: the quantity of the evidence as well as the quality, the appropriateness of that evidence. So the practitioner is to plan his work and perform an assured engagement with an attitude of professional skepticism to obtain sufficient appropriate evidence about whether the subject matter information is free from material misstatement. Remember, by the end of the day, auditors are only worried. These guys are not worried about everything. They are worried about things which are material. Okay, so the item should be material for it to be noticed by the auditor. Otherwise, it will go unnoticed. So we are talking of materiality. Okay. So the auditor is to plan his work to ensure that by the end of the day, the financial statements are not materially misstated. So that's the objective of the auditor. So what is an attitude of professional skepticism? When we talk of professional skepticism, we are referring to the practitioner's attitude, okay? The practitioner's attitude in questioning the validity of evidence, and he will be very alert to evidence that brings into question the reliability of document or representation. Skepticism means that you don't know unless evidence has been brought about. So it does not mean that the practitioner assumes everyone is dishonest or that figures have been deliberately misrepresented, nor does it mean that you believe all figures in the financial statement are correct. It simply means that you are aware that we can all be subject to optimism, perhaps too much, or there could be some human error or even mechanical error. Okay, the computers might sometimes go wrong. Okay, giving quick answers because we are not short of time, misunderstanding, etc. So maybe if we are short of time, we might end up being, prepare our financial statements in a hurried fashion and ending up making a series of mistakes. So the auditor would be exercising his professional skepticism to actually be in a position or to have some headroom to come to some conclusion that perhaps something might not be okay with the information that has been presented before him. So it also recognizes that sometimes people are deliberately misleading or dishonest. Sometimes with this professional skepticism, auditors might be helped or assisted in coming up with a good position to pinpoint or to be able to identify that something might be deliberately misrepresented or dishonest. Skepticism also means that evidence is required to test statements or assumptions. You could almost summarize the process of assurance in the phrase, collect evidence that supports everything that is being claimed. So if the directors are saying that we have made this particular profit, you just have to actually question, is that true? Okay, is that true? What is the evidence that is available for me to believe their assertion? So sufficiency is the measure of quantity of evidence, appropriate is the measure of quality of evidence, its relevance and its reliability. So the reliability of evidence is influenced by its source and by its nature. So when we are talking of appropriateness, we are simply saying that of the evidence should be reliable as well as relevant. So reliability is influenced by the source of the evidence, its nature, and is dependent on the individual circumstances under which it is obtained. For example, documentary evidence is better than oral. Okay, sometimes we need not to be told that the bank statement, the bank balance is 90,000. We need to see the bank statement itself for us to believe that actually the bank is $90,000. Directly obtained evidence is better than evidence provided by a client. This is considered further in future slides. Now, the assurance report. The practitioner provides a written report containing a conclusion. In a reasonable assurance engagement, the practitioner's conclusion is weighted in the positive form. For example, in our opinion, internal control is effective in all material respects based on XYZ criteria. But when we are talking of limited assurance engagement, the conclusion is weighted in the negative form. For example, based on our work described in this report, nothing has come to our attention that causes us to believe that internal control is not effective in all material respects based on XYZ criteria. So you can see that the reasonable assurance engagement is an example of an audit engagement. But when you are talking of limited or negative assurance, negative assurance, this is an example of a review engagement. A review engagement. You will see as you proceed with the course. Now, positive and negative assurance. Example, positive. The financial statement show a true and fair view. The value of amount of event loss is this. These are positive. The practitioner will be expressing his opinion in a positive sense. But in a negative engagement, assurance engagement, we have an example of an opinion would be, we have discovered nothing wrong with the financial statement. The basis of the forecast is not unreasonable. There is no evidence of discrimination in the appointment. The practitioners do not want to come out open of what actually is obtaining, but they come in a reverse order where they will just say that nothing has come, nothing has been this, or there's no evidence that A, B, C is happening. Okay. Now let's talk about the corporate governance issues. We are likely to be examined on the corporate governance issues that happen in entities. So we have to be prepared to ensure that we are home and dry with these corporate governance matters. Corporate governance is the means by which a company is operated and controlled. Okay? The aim of corporate governance initiatives is to ensure that companies are run well in the interest of their shareholders and the wider community. So when we talk of corporate governance, we are not only looking at shareholders, but we are also worried about the community. The community or the government. Okay? Everybody, all the stakeholders. This is the issue of stakeholders. Alright? So, in the US, in response to major accounting scandals like the Enros, the WorldCom, the Philadelphia, the Parmalat, etc. All those scandals, they have ignited or forced regulators to seek to change the rules surrounding the governance of companies, particularly publicly owned companies. In the US, the Sarbanes-Oxley Act 2002 introduced a set of rigorous corporate governance laws. At the same time, the UK Corporate Governance Code introduced a set of best practice corporate governance initiatives into the UK. External auditors in the UK are required to report on whether listed companies are compliant with the code. And this particular code is actually, ladies and gentlemen, what is going to give us guidance in most of our corporate governance questions in this particular paper, audit and assurance. We are looking at this UK corporate governance code, which is also believed to be the best practice code. Alright, so the principles of corporate governance of the corporate governance code are considered best practice and are examinable for this paper. Statement of the company, the auditor will examine them and give some opinion to the members of the company as to whether the financial statements were true and fair. Without that assurance, the members of the company really would have little idea on whether or not the information could be relied upon. So the auditors therefore examine the financial statements, and this adds credibility to those statements. The shareholders have much better idea of the performance of the directors of the company. So that's actually the idea behind the auditing issues. Now, not that shareholders appoint the independent auditor, they also appoint the director. So we have got a situation where we have got the owners of the company, these are the shareholders. Okay. But you must have to know that these guys appoint the directors of the company as well as the auditors. So in the exam, you may be asked, who appoints auditors? Or which of the following appoint auditors? Please do not select directors or audit committee or whatever. Those guys, they do not appoint auditors. Auditors are appointed by shareholders. Similarly, directors are also appointed by shareholders. Are we together? So you might be given a situation where a director is threatening an auditor that I am going to fire you next year, we are not going to choose you, this and that. Hey, that's not their remit, that's the remit of shareholders. Please do not be confused there. So the principles of corporate governance. There is this animal called OECD, the Organization of Economic Cooperation Development, which promoted 6 principles of good corporate governance. The corporate governance framework should promote transparent, fair market and support effective supervision and enforcement. So when you are talking of a good corporate governance code, it should be transparent, it should promote transparency and fair market. Okay? Okay? So, this framework should also protect shareholders' rights and ensure all are fairly treated, including minority shareholders. So, a good corporate governance code should also have this second attribute. It should provide for stock markets to contribute to good corporate governance, for example, by prohibiting insider trading, and usually this is the case worldwide. For example, on the Zimbabwe Stock Exchange, if you are found to be liable, if you are found to be responsible for insider trading, then you will be in for it. Okay, it's a criminal offense as well. It should recognize the rights of all stakeholders, not just shareholders. We talked about the issues to do with all stakeholders, the community, the government, pressure groups, employees, and also shareholders. It should ensure timely and accurate disclosure of all material matters, including financial position, performance, ownership. So, a good corporate governance code should ensure that financial statements should be prepared, reflecting all the matters, the financial position, performance, ownership, and the governance of an entity. It should ensure that the strategic guidance of the entity is pursued. Okay, it should ensure strategic guidance of the entity, effective monitoring of management by the board, and the board's accountability to the entity and their shareholders. That's all for the OECD. Okay, now the Corporate Governance Code, the UK Corporate Governance Code, its main principles: board leadership and common purpose. Each company to be headed by an effective board with collective responsibility. This is why I say that the responsibility of financial statements is for the board, not only one director, but the board of directors. Directors to be of higher integrity, lead by example, and further the desired corporate culture. Division of responsibilities, there's going to be a person called CEO and a person called the chairman. These roles should be clearly spelled and positions to be held by 2 separate individuals, according to the UK Corporate Governance Code. Composition, succession, and evaluation. Appointments to be formal. Okay, it's not going to be like a backdoor arrangement where someone can walk up tomorrow and become a director. It should be something that has to be formally done. Okay, rigorous, transparent, etc. Diversity of skill and experience to be considered when appointing directors. Membership to be regularly refreshed, with the chairman position not to exceed 9 years consecutively, according to the UK Corporate Governance Code. So in an exam, you may be asked things to do with these corporate governance issues, and you just have to highlight where you where you see that the corporate governance itself was not in good order or good shape. Audit, risk, and internal control. Risk management to be responsibility of the board. A clear and formal process to be followed when appointing or retaining internal and external auditors. An audit committee of NEDs to be established by the board. Then the remuneration. In essence, remuneration should be sufficient to attract, retain, motivate directors of sufficient quality, but avoid paying more than is necessary. So this is all about the UK Corporate Governance Code. Now, on remuneration again, we can add these 2 points, that a significant portion of executive directors' remuneration may be structured to link rewards to corporate and individual performance. In other words, profit-related pay is encouraged. Directors should not receive high pay irrespective of common performance. So we need a situation, or we advocate for a situation where the director's performance is actually motivated by the profit earning potential of the company, as well as the market trend. Okay, but we do not want a situation where directors are just going to be paid regardless of the performance of the company. We need to see that the company is actually being seen to be performing well, and the directors are also being paid well. Okay, so we need to link rewards to corporate and individual performance. Okay, are the directors working by themselves? Sometimes you discover that the directors will not be working. So in that situation, we just have to assess if the company is doing well. All right. There should be a formal and transparent procedure for developing policy on executive remuneration and for fixing the remuneration packages of individual directors. No director should be involved in deciding his or her own remuneration. This means that a remuneration committee should be there to guide the process. All right. So we've got the audit committee there. The composition: minimum 3 non-executive directors, at least 1 with financial expertise. This is normally comes in every exam. Okay. Then the objective of the the audit committee should be to increase public confidence, financial awareness of non-executive directors, then liaison with external auditors. There is no way which is written appointment. They are not the ones who appoint external auditors. Please. Okay. The function: financial statements. They review the financial statements. Okay. They're also responsible for the controls, internal controls, responsible for the internal audit, and also external audits. They supervise to see what's going on. They are also responsible for whistleblowing this audit committee. As can be seen, an audit committee is a committee consisting of non-executive directors which is able to view a company's affairs in a detached and independent way and liaise effectively between the main board of directors and the external auditor. Okay, those are the roles of the audit committee. Alright, monitoring and reviewing the effectiveness of internal audit. Companies don't have to have an internal audit department, but the need for one must be reviewed annually. Not every company is required to have an internal audit department, but every year they need to evaluate if there is such a need. Then monitoring the integrity of financial statements and reviewing significant financial reporting judgment. They have to oversee actually before external auditors come. This audit committee should also monitor the integrity of the financial statement to see if the guys in the finance section are doing it right. Review the internal financial controls and risk management policies or systems, unless there is a separate risk committee or board, or the board does this. Then making recommendations to the board about the appointment, reappointment, and removal of external auditors and agreeing the terms of engagement. You can see here that they only make recommendations when it comes to external auditor. These guys, they make recommendations. Why do they make recommendations? Because the issue of appointment of external auditor is the prerogative of the shareholder. Alright. Annually, assessing the independence of the activity and effectiveness of the external auditor, including confirming that there are no soft interest or familiarity issues and that partners and staff are treated properly. So you can see that this audit committee is actually full of guys who know. Okay, they are actually the eyes of the shareholder, the eyes of the board itself. Okay, they represent the board. Okay, with regards to independence of external auditors and the way they are conducting the audit. All right, acting as a forum to link directors and auditors, right, where the directors don't agree with auditors and the auditors don't agree with the directors. This audit committee, they actually act as a forum where such issues or contentions are deliberated from time to time. Auditors will typically write to the audit committee about any problems they may be having on the audit and obtaining all the information they require. If the auditors are worried in some way about the financial statement, they will raise those complaints with the audit committee. Okay? Then that's it. Developing and implementing policy on engagement of the external auditor to supply non-audit services. So sometimes when the companies come to terms and say, we need these auditors to come here and help us with some other functions or other services, it is the audit committee that needs to develop and implement some policy on the engagement or such engagement. Okay? Now, the comply or explain principle. This is different from the comply or else. They are different. Alright. So the code, the UK code, is no force of law and is enforced on listed companies through the stock exchange. Listed companies are expected to comply or explain, and this approach is the trademark of corporate governance in the UK. Listed companies have to state that they have complied with the code or else explain to shareholders why they haven't. This allows some flexibility, and non-compliance might be acceptable in some circumstances. Now, this is the last segment where we'll be talking about the rights of the auditors, their appointment, removal, resignation, and regulation. We have actually talked much about this, but here we just have to give it a go. Alright. In most jurisdictions, external audit is regulated by the common law or statute. The AA syllabus requires you to have only a basic knowledge and comprehension of statutory regulation, which is illustrated in this chapter based on English law. So the auditor's rights and duties. Auditors have a right to access to all records they require. Okay, there is no way a company employee is going to say, hey, I'm going to give you this cash book but not that one and this record. No, when the auditors have come, they have to have access to everything, to all the records which they require. Okay, they have a right to receive information and explanation of all transactions from every employee. They have a right to attend and receive notice about general meetings, and they have right to speak at general meetings on relevant matters. A general meeting is where the shareholders of the company come together, and the annual general meeting ensure that there should be at least one of these meetings every year. The auditors have the right to receive in advance information about any information that are proposed to be put at this general meeting. And finally, they have the right to require that the company's financial statement should be presented at the general meeting. Otherwise, of course, if the financial statement contains information which the directors wanted to keep secret, the directors could delay presenting those. So the auditors have the right to see whatever information that is to be that relates to the financial statement. Okay, they should require that the common financial statement be presented to the general meeting. Otherwise, of course, the financial statement will not be presented. Alright, so the auditor has that right to say, may you please make the director present the financial statement. Alright, at the general meeting. At this juncture, the auditors would want to see, or would want the users to actually know what is being reported. Okay? During the time when they are present, actually to ensure that the directors will not hide anything. If the auditors do not agree with what is being presented during the general meeting, they will have a voice. They will actually say, Mr. Director, you are presenting wrong information or you're hiding something. So this is why they have this right. Okay, their right to be informed about, attend and speak at general meeting gives the auditors an opportunity to communicate directly with the shareholders for whom they have been appointed and for whom they are acting. So here are now the typical duties of these auditors: to issue an auditor's report giving opinions on truth and fairness of the financial statements, whether the financial statements are properly prepared, and other opinions required. When leaving a client to issue a statement of circumstances, they have to actually explain why they are leaving the client. After resignation, to supply information to the new auditors. So you must also appreciate that if you left a client and then another auditor comes to that client and that auditor requests some information from you and you refuse to supply them the information, that will be subject to disciplinary action from the ACCA. You just have to take note of that. So the issues to do with professional behavior actually arrest us in this regard. Okay? They control our behavior with those clauses. So, but who is an auditor? An auditor must be somebody who has passed an approved set of professional examinations such as the ACCA. Okay, the ACCA qualification actually gives somebody the route to become an auditor one day. So you should have passed the professional examination set by a recognized qualifying body, the RQB. For example, in ACCA, ACCA, okay, ICAS, okay, ICAS, the CPA. There are so many regulatory bodies, especially in Zimbabwe. Okay, in Zimbabwe we've got the ACCA, ICAS, CPA. I think auditing. These are the ones. Okay. Yes. Yes. For auditing. Yes. Must be a member and stay a member of a recognized supervisory body to some of the ACCA. So we are saying that this guy, this auditor, should remain. He should maintain his membership with these professional bodies. Then the ACCA, the auditor must not be a director or employee of the company or of any associated company. Okay, this is very problematic, where you see that there are some guys who want to be employed for the company, but at the same time they want also to be the auditors of that company. It doesn't work like that. It's either you are the employee of the company and you are not the auditor of that company, or you are the auditor of the company but not the employee or director of that company. The auditor must not be an employee or business partner of a director or employee of the company or of any associated company. So there should be some far much detachment. You are not supposed to be linked to your client. Auditors have to be reappointed by resolution at every annual general meeting. Note that reappointment is not automatic. This is to prevent the incumbent auditor from simply staying in office. Every year there should be some annual general meeting resolution, okay, by the shareholders of the company, where they have to reappoint the auditor. Otherwise, if it was an issue of being there automatically, or there being in office automatically, then auditors would slip from duty. So their performance is to be evaluated at least almost on an annual basis. Then the requirement for a resolution means that the members have to take positive action to get auditors appointed. Otherwise, they might not be reappointed, or they may be reappointed without careful thought. So the issue for this requirement puts task upon the members of the Council to actually be active in the appointment of auditors. Now, prior to the first annual general meeting, the directors can appoint the first auditors, or if an auditor resigns, for example, because he or she falls ill, the directors can appoint another auditor to fill a casual vacancy. This appointment will only last until the next annual general meeting by the members or of the members. If all else fails, in the UK, the Secretary of State, in other words, the government, will ensure that all companies have an auditor. So this, when the situation gets to the extreme, this is when the government gets in and starts to dictate things within a particular company. Okay, but that's a very rare scenario. The actions that the auditor should take when approached by a potential client are explained later. Now, auditors, like anybody else, can resign. Okay, auditors can resign by giving the same notice and a statement of circumstances to the company. A statement of circumstances explains why they resigned. A written notice must also be sent to the regulatory authority and the members of the company. So the thinking behind this is that auditors may have resigned because they are deeply concerned about some aspects of the company's activity. So the statement of circumstances explains why the auditor resigned, which could of course have been caused by perfectly innocent reasons. For example, that the auditor wishes to cut back on work, or the auditor feels that the company is now too large for the audit itself to deal with. If the auditors are really concerned about the company and that's why they have resigned, they could also require the directors to call a general meeting. The auditors can speak at these meetings, and therefore they can address the members and explain their concern and why they have resigned. Okay? But some auditors are removed. Here is why. Auditors can be removed from office. This will normally be at instigation of directors, but the resolution must be passed by the shareholders. This is why we say that it's not the remit of the director. Only the shareholders have the power to actually remove an auditor from office. They could be removed from office for perfectly legitimate reasons. Perhaps the auditors failed to find a material fraud in the company, and the directors have lost faith in them, or perhaps the company has now become international and a larger firm of auditors is needed. So automatically, the auditors will be removed from office. However, the big fear is that the auditors were perhaps too good, too strict on insisting that certain aspects of financial statements should be changed, or perhaps they issued a modified, not clean report or opinion because the directors refused to change the financial statements. This is why the auditors are given the right to make recommendations about why they should stay in office. They have to deposit a statement of circumstances at the company's office, and this should be sent to the regulatory authority. The auditors can also receive notices, speak at general meetings at which the term of their appointment will have expired. So we've actually talked about this, and here is just a rebut of what, a reinforcement of what we have already said. So by so doing, this allows auditors, if necessary, to explain to shareholders what is happening and that they may have been removed without due cause. So, regulation. What is regulated by? Their professional bodies, for example, the ACCA, they regulate their performance. For example, like I've indicated earlier on that if you happen to have been an outgoing auditor and then an ingoing auditor comes and then try to approach you on circumstances why you left the company and you fail to give satisfactory reason to these guys, they may report you to the ACCA and you may be disciplined for that. National bodies, for example, in the UK, there is the Financial Reporting Council, which also regulates the auditing profession. In the national body, for example, the IFAC, they regulate the audit profession. The purpose of IFAC is to serve the public interest by establishing and promoting adherence to high-quality professional standards. It is a number of boards, including the International Auditing and Assurance Standards Board, the IAASP, okay, which sets international standards on auditing and other assurance standards. Then the National Ethics Standards Board for Accountants issues the International Code of Ethics for Professional Accountants. Then IAASP's ISAs are adopted by the Financial Reporting Council of the UK, which is local regulatory power. The ISBA code has been adopted by the ACCA in its code of ethics and conduct. So this means that if you violate any provision within the IESPA code, you have automatically violated the ACCA code of ethics because they are just one. The ACCA is just adopted it 100%. I hope you have benefited a lot from this presentation, and I just urge you guys to attempt the exercises which we sent to you. Those exercises are meant to ensure that you have understood what we've learned in this particular week. We are giving you 7 days to do the work, so just feel motivated to do the work. Otherwise, if we do not do the work, we're not going to progress in our studies. Until we meet again next week, may the good Lord bless you and continue to bless you. I'm signing out. Goodbye.